Okay, so let's start. We want to start a new topic. And our new topic is called government grants. That's the one we want to do now. Let me introduce it. Let me introduce what it is, what are government grants, and how do you account for them? How do you account for government grants? Now, whenever you are given an assistance by the government, that assistance could be in form of cash or could be in form of any other resources. So any assistance that you receive from the government, either in form of cash or in any other kind, then that is what we call a grant. So we normally define government grants as assistance that you as a business, you receive from the government in form of transfer of resources. When the government transfers resources, they give you assistance in form of transfer of resources. Either those resources are in form of cash or in any other form of kind, then we are saying that is a government grant. So that is what we are saying. It's the main thing is assistance that is received from the government in form of transfer of what? Resources, in form of transfer of resources. Once we know what are government grants, then we need to know what are the various types of grants. As a business, what are the various types of grants that you can receive from the government? Having said, it is the transfer or it is the assistance that by the government in form of transfer of what? Resources. One type of grant is what we normally call capital grant. As a business, you may receive what we call capital grant. Number two, you may receive what we call revenue grant. Revenue grant. Number three, you may receive what we call non-monetary grant. Non-monetary grant. So what are these types of grant? What are these types of grant? Now, when you receive a capital grant, we say these are grants related to assets. Any grant that you are given to purchase, listen, any grant that you are given to purchase or to construct a long-term asset, then that kind of a grant is what we call a capital grant. Given some money as a business to either acquire land or to build a road or to build a building, that kind of a grant is what we call capital grant. These are grants that are related to assets. Grants that are related to assets. That's what we are saying. So we are saying these are grants that you are given either to purchase or to construct a long-term asset or to construct a long-term asset. What about revenue grant? These are grants that are related to income. Any grants that are related to income, then, for example, listen, you are given some money, then you are told, use this money to meet the normal running expenses of your business. Maybe to pay employees or to pay for electricity or whatever. You are given some grant by the government and the condition is use it to meet the running expenses of your business. That kind of a grant, what we call a revenue grant. A revenue grant. So that is the second type of grant you as a business, you might receive from the government. The third type of grant is what we call non-monetary grant. And this is when the government gives you or transfers to you an asset. When they transfer to you an asset in form of cash, land, maybe a fixed asset, or they give you a machinery, or they give you maybe a bus, maybe you are a non-profit making organization and they give you a bus, that kind of a grant, what we call a non-monetary grant, is what we call non-monetary grant. Okay, So before we talk about how to account for them, let's put down something, what we have already said. Listen, what have we said so far? We have said what's a grant. We have defined a grant as a transfer, a grant is any assistance by the government in form of transfer of resources. Say those resources could be in form of cash or in kind. Okay, that's one. And what are the types of grant? Say there are three types of grant. Is a capital grant, which are related to what? Long-term assets. You are given cash towards the purchase or construction or a long-term asset, but cash is involved. Revenue grant, given cash towards revenue, or we say a grant related to revenue or income. Grant related to revenue or income. That means for the normal running expenses of your business. And monetary, we are saying this is where the government gives you assistance in form of transfer of fixed assets like land or maybe machinery. Good. So let's put down that first. Let's put down that. Put down the topic. Topic is government grants. The topic is government grants. Then you say this. Government grants are assistance. Government grants are assistance by the government. Government grants are assistance by the government in form of transfer of resources. Government grants are assistance by the government. Assistance by the government in form of transfer of resources. In form of transfer of resources. I.e. in kind or cash. Kind or in cash. Kind or in cash. Then have another subheading. Types of grants. Types of grants. Types of grants. Number one, capital grant. Capital grants. Capital grant. Then you put a dash. These are grants relating to. These are grants relating to assets. These are grants relating to assets. I.e. grants to purchase or construct. Grants to purchase or construct long-term assets. Grants to purchase or construct long-term assets. 2. Revenue grant. Revenue grant. Revenue grant. You say this. These are grants relating to income. 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 3. Non-monetary grants. Non-monetary grants. Non-monetary grants, e.g. non-monetary grants, e.g. transfer of land or other resources. Non-monetary grant, e.g. transfer of land and other resources. And other. Good. Let's now continue from there now. Let's continue there now. Okay. Let's continue. What we want to talk about now is how do you account for these types of grant? How do you account this type of grant. You as a business, you have received a capital grant. Maybe you are receiving 100 million towards the purchase of a road, towards the purchase of a building, or towards the construction of a road, whatever it is. How do you account for them? Okay? So let me talk about how to account for capital grant. Let me talk about it first. How do we account for capital grant? How do you account for capital grant? Now, before maybe I talk about how to account for capital grant, let me explain this. Before I talk about how to account for capital grant, there's a request now. If you are in this group or you are watching this video and please you have not subscribed. If you are watching this video and you have not subscribed, please subscribe to my YouTube channel so that you can get notification whenever we post new videos into the YouTube. Maybe watching, or you may be in this group and you have not subscribed to my YouTube channel. I know there are new people, so please subscribe. You can hit that subscription button even as you're watching this video, So please subscribe if you have not subscribed so that you get notification whenever we post new videos into YouTube. The other appeal now to everybody who is watching, please inform your friends that we have online classes. We have online classes for financial reporting, which is the one we are doing. Also for advanced financial reporting and for financial accounting. Tell them we have online classes for these three subjects. That is financial reporting of the intermediate, advanced financial reporting of the advanced level. For that one, we have either early morning, you can tell them, or evening classes. Then we also have financial accounting. You can also tell them if they are not able to attend live classes, they can still buy what we call pre-recorded videos for these subjects. You can tell them they can also buy what we call pre-recorded videos for these subjects. Okay? Yes. We are charging 4,200. You can tell them that. The whole syllabus. We also accept payments in installments. No problem. If they are interested, they can call me on this number 0722 65 8875. Tell them that if they are interested, they can call me on that number for more information. 0722 65 8875. Okay? Let me now continue. That was what I wanted to put as an appeal. One is to subscribe to the YouTube channel if you have not subscribed and you're watching the video. Two, informing your friends about our online classes for financial reporting, advanced financial reporting, and financial accounting of foundation level, or even the ATD one, either ATD level 1 or ATD level 2. Also, that they can buy what we call pre-recorded videos, how much we are charging the whole semester, and we also accept payments on installments. If they're interested, they can call 0722 65 8875 for more information if they're interested. Okay, I think we can now continue. This is 7.5. Okay, I think we can now continue. Allow me to continue now. So I wanted to talk about government grants. How do you account for government grants? Now listen, there are two methods. Let me continue now. There are two methods of accounting for government grants you have received. Let us assume, listen, you as a business, you want to buy a machinery. That machinery will cost you 100 million. But the government gives you cash of 10 million towards the purchase of that machinery. That means they give you a grant towards the purchase of this machinery. There are two methods that you as a company you can deal with in accounting this type of grant. Number one is what we call first method. Let me them here, methods of accounting for capital grant. One of them is called asset cost reduction method. Asset cost reduction method. Don't write. Asset cost reduction method. I will explain it in a short while. Number two is what we call deferred income method. Deferred income method. Let me start with the first one, which we are calling the asset cost reduction method. Listen, you bought a machine at a cost of 100 million. So you must have debited, as a business, you must have debited machinery account, and you must have credited cash by 100 million. That's what you as a business you paid towards the purchase of that machinery. Then the government gave you a grant of shillings 10 million. If you choose the first approach of accounting for that 10 million, which is what we are calling the cost reduction method, asset cost reduction method, it means, listen, you use that 10 million to deduct that 10 million from the cost of the asset. In other words, you will debit bank, you are receiving that 10 million, you will debit bank and credit the asset. Come and see your cash, 10 million. Listen, so that from now onwards, your machinery will appear in your books now, not at 100 million, but it will appear in your books at 90 million. At 90 million. So when you are depreciating your machinery as a business, now you don't depreciate it on the original 100 million. Now you depreciate it on 90 million. So that is a method you can use to account for government grants. We call it asset cost reduction method. Listen, where the grant is deducted. Listen, where the grant is deducted from the cost of the asset in arriving at, listen, in arriving at the carrying amount of the asset. In arriving at the carrying amount of the asset. Our carrying amount of the asset now is 90 million. Then I've also said, this asset now will be depreciated. It will be depreciated on the carrying amount. It will be depreciated the carrying amount. So in your balance sheet, let us first see in your P&L account. Let us assume you are told to prepare P&L extracts for 3 years. In year 1, what will you charge in your P&L account as depreciation? It will be 90 divided by the useful life. Let us assume the useful life is 10 years. So every year, we're going to depreciate how much in the P&L account? 9 million. Year 2, 9 million. Year 3, 9 million. That's how you account for that. You are deducting the grant from the cost of the asset in determining the carrying amount of the asset. And I've said you depreciate the asset on the carrying amount. The asset is depreciated on the carrying amount using whichever method. If it's straight line method, of course, most questions will say straight line method. Okay, you depreciate the asset on the net amount after deduction. Good. Then when it comes to balance sheet, then you can say year 1, 2, year 3. So you will have your machinery at cost. Machinery 90 million less depreciation accumulated. How much? 9. That will leave you with how much? 81. Second year, 90. Now you minus the accumulated of 18. Remember, year 1 you charge 9. Now you are charging another 9. That's 18. That leaves you with how much? 72. Third year you have 90 minus the accumulated. That is 27, I think so. Yes. Remain with a balance of how much? Is it 63? I think so. Good. That's how you account for the grant if you are to use the first method. Or in other words, that's how it will affect the financial statements in the name of income statement and balance sheet. That is not a difficult method where we are accounting for grant using the asset cost reduction method. In other words, you deduct the grant from the original cost of the asset in determining the carrying amount of the asset. I've said the asset is depreciated on the reduced amount, over its useful life. Good. That's the first method. The second method is what we are calling deferred income method. Deferred income method. That's what I want to talk about now. I want you to follow now. This is the second method which we are calling deferred grant income. You can call it deferred grant income. Let me illustrate. I want to assume the same figures. You bought a machine for 100 million. You debited your machinery account by 100. Cash. 100 million. Then the government gave you a grant of 10 million. Listen. This time, you don't net against that 10 million. You don't net it against this value of 100,000, 100 million. No. Instead, listen, you consider that 10 million as a deferred income. As a deferred income. I will explain in a short while. Whereby you will debit bank. You are receiving, you will debit bank and you credit what we are calling deferred grant income. Deferred grant income. Okay? You debit bank and you credit that. In year 1, you come and see a cash, 10 million. Now listen. Then this 10 million will be recognized as an income in the P&L account. It will be recognized as an income in the P&L account over the useful life of the asset. Over the useful life of the asset. What I mean is this. If the asset has a useful life of 10 years, then from this deferred income, you will be transferring to the P&L account how much? The useful life is 10 years. So every year you'll be transferring 1 million to the P&L account as an income. You don't recognize the whole 10 million. Listen, you received a 10 million. That's true. But you don't recognize all of it as an income in year 1. That's why we are calling it deferred grant income. So that you recognize the 10 million, yes, as an income, but over the useful life of the asset. We're assuming the useful life of the asset is 10 years. So in year 1, you will transfer from this account to the profit and loss account as an income, how much? 1 million. Then you carry down a balance of 9 million to be recognized as an income in the future. Then you bring down the balance by the beginning of year 2, balance brought down 9 million. Then again in the second year, you recognize or you transfer from this deferred of 9 million, now recognize another income to go to the P&L account this year of how much? 1 million again. Come and see here to the P&L account, another 1 million. Then you carry down the balance of 8 million. Good. Then you bring down the balance by the beginning of year 3. Come and see a balance brought down. That is how much? 8 million. Then you again transfer to the P&L account that year. How much? Another 1 million. Then you carry down a balance of how much? 7 million. That way, until the end of the 10th year, where you would have recognized the 10 million as an income. That's why we are calling it a deferred grant income. A deferred grant income. Okay? Where we are saying the income is deferred and it is recognized. Listen, the income or the grant is considered as a deferred income to be recognized as an income over the useful life of the asset. Then I've said the asset will still be maintained at its original cost, which is still how much? 100 million. Meaning, in your P&L account, how much will you be charging as depreciation? As depreciation. If you are told to prepare profit and loss extracts, year 1, maybe year 2, year 3, how much will you depreciate as your depreciation? It will obviously be 100 million divided by the useful life. I'm assuming 10 years. So you divide that by 10, 100 million by 10, that means you are going to recognize 10 million every year. 10 million every year. Now listen carefully. With this method now, there will be something else that will go to the P&L account. And that is what? An income. That's what we are calling grant income. In the P&L account, every year I was recognizing how much as an income? 1 million, 1 million, 1 million every year. Are you seeing it there? Good. That's what you will take to the P&L account every year. This time, your P&L account will show two things. Your depreciation and at the same time, your income that you are recognizing every year. Good. That's as far as P&L account is concerned. What about balance sheet? When it comes to balance sheet, that is the statement of financial position. Balance sheet. Listen to this now. For the balance sheet, again, year 1, year 2, year 3. You will have your machinery at cost. Machinery at cost. That is 100 million. Now you will have less accumulated depreciation of 10 million in the year 1. That will give you a book value of 90. Second year, the cost is 100. Accumulated depreciation is 20. That will give you 80. Third year, the cost is still 100. Depreciation accumulated is 30. That will give you 70. Now listen. This time, listen, there's something else to go to the balance sheet. This time there is that deferred income. Deferred income. Listen. In year 1, you received 100 million. Listen carefully. You received 10 million as a grant income. And we are considering it as a deferred income. Listen. To be recognized as an income over the next 10 years. Meaning, you are receiving an income in advance. In advance. You all know from your accounting knowledge, income received in advance is considered as a liability. When you receive an income in advance, it is considered as a liability. It's not an asset, it's a liability. Now listen. So by end of year 1, there is this balance you are carrying down in the deferred income account. How much? 9 million. That is the amount you have received by end of year 1. Listen, to be recognized as an income in the next 9 years. We are doing balance sheet of year 1, end of year 1. So you still have a balance of 9 million to be recognized as an income in the next 9 years. Listen. But out of that 9 million, listen, there is a 1 million to be recognized as an income in the next 1 year. Don't forget. Every year we shall be recognizing 1 million to go to the P&L account. That's what we have seen. So it means, listen carefully, means this 9 million as an element that will take me more than a year to recognize, and that 9 million has an element in it which will take me less than a year to recognize. So how much of the 9 million will take me less than a year to recognize? If 9 million is to be recognized as an income in the next 9 years, but by end of year 2, I should have recognized an extra 1 million out of it. So it means out of that 9 million, 8 million will take me more than a year to recognize. I hope you're following. 8 million will take me more than a year to recognize. But there is another 1 million which will take me less than a year to recognize. That's what you now would consider as a current liability. So out of the balance you are carrying down by end of every year, there will be a component that is considered to be a long-term income received in advance, and another component which you can call an income received in advance, but for a period of less than a year. So if you are told to do balance sheet, then in that balance sheet, we have already done the asset side. Among the non-current liabilities, you will have their deferred grant income. Then somewhere along the current liabilities also, you will have their deferred grant income. By end of year 1, we saw we are carrying down 9 million. How much of that 9 million take me more than a year to recognize? More than a year. Because we have seen every year I'll be recognizing 1 million. 1 million. Out of the 9 million by end of year 1, 8 million take me more than a year to recognize. 1 million will take me less than a year to recognize by end of year 1. Then from the account, what were we carrying down by end of year 2? We were carrying down another balance of how much? 8 million. How much again out of this 8 million? It's a liability, an income received in advance. How much out of that 8 million will take me more than a year to recognize, and how much of that 8 million take me less than a year to recognize? Okay? Seeing again, out of that 8 million, 1 million will be recognized in the next 1 year. 1 million will be recognized in the next 1 year, which automatically means that out of the 8 million, 7 million will take me more than a year. So in other words, you can see, I hope you are noticing that by end of year 2, when I'm carrying down 8 million, what I'm going to recognize in the next 1 year will be current. What remains as the carry down by end of year 3 will be long term of year 2. What I'm carrying down as balance of year 3, I'm going to consider it as long term of year 2. You look at year 1, I carry down 9 million. Out of that 9 million we saw, 1 million is current. I'll recognize it in the next 1 year. Then 8 million, which is the balance of year 2, becomes the long term of year 1. I hope you have noticed that. That's what we are trying to say. So it means, therefore, by end of year 1, how much is long term? 8. How much is current? 1. Then we go to the question again. By end of year 2, what was I carrying down? I think I was carrying down 8. Let me confirm. Yes, we are carrying down 8. Out of that 8, we have said 1 million will take me less than a year to recognize as at the end of year 2, which automatically means another 7 million will take me more than a year to recognize as an income. Will take me more than a year to recognize as an income. Then when I come to year 3, I go back and check, what am I carrying down? I'm carrying down 7 million. Obvious, out of that 7 million, 1 million will take me less than a year to recognize. And the balance of 6 million take me more than a year to recognize. Will take me more than a year to recognize. I hope you have understood this method we are calling deferred grant income. So those are the two methods. Listen, those are the two methods of accounting for capital grant. Those are the two methods of accounting for capital grant. First method was which one? Where I said we can call it cost reduction method or asset cost reduction method. Where I said you deduct the grant from original cost of the asset in determining or in arriving at the carrying amount of the asset, or the reduced carrying amount of the asset. When you received the grant, debited cash, you credited the asset. That means you just offset. That's what we said. When you bought the machine, you debited machinery, credited bank. When you received the grant of 10 million, you decided as a company, you're just going to debit bank, credit the machinery. That means you netted. That way, you remained with a balance of 90. Listen, that method, once you account for the grant as a reduction of the cost, then you have nothing else to do with that grant in the future. Once you debited cash and you credited machinery by the end of year one with the grant, then you have nothing to do with the grant there onwards. Where I now said, just depreciate the asset on the reduced carrying amount, on the reduced carrying amount. Good. That's all for method one. Then I've talked about second method of accounting for government for capital grant. That's what we are calling deferred grant income, where I've said that income that grant you are receiving, you consider it as a deferred income to be recognized as an income over the useful life, be recognized as an income in the P&L account over the useful life of the asset. Okay? So before we go to the second type of grant, that is revenue grant, let's put down on what we have already said. Let's put down what we have already said. Let's put down what we have already said. So where did we stop? I think we just mentioned the types of grant. So, so we were to account for government grants. So andika another subheading, accounting for capital grant. 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 Then you say this. The following are the two methods. The following are the two methods. The following are the two methods of accounting for capital grant. Following are the two methods of accounting for capital grant. Following are the two methods of accounting capital grant. Following are the two methods of accounting capital grant. Number one, asset cost reduction. Asset cost reduction method. Asset cost reduction method. Then you put a dash. Asset cost reduction method. Then you put a dash. Then you put a dash. Where the grant is deducted. Where the grant is deducted from the cost of the asset. Where the grant is deducted cost of the asset in arriving at. Where the grant is deducted from the cost of the asset in arriving at the carrying value. In arriving at the carrying value of the asset. In arriving at the carrying value of the asset. In arriving at the carrying value of the asset. The paragraph. The paragraph. The asset is depreciated. Asset is depreciated over its useful life. Asset is depreciated over its useful life. Asset is depreciated over its useful life on the reduced amount. Asset is depreciated over its useful life on the reduced amount. On the reduced amount. on the reduced amount. Yeah. Number two, deferred grant income. Deferred grant income method. Deferred grant income method. Deferred grant income method. Then you put a dash. Deferred grant income method. Put a dash. Where the grant is considered as a deferred income, where the grant is considered as a deferred income, to be recognized as an income, over the useful life of the asset. Where it is recognized as an income over the useful life of the asset. Okay. Now, maybe we shall do an example later, but let me talk about the second type of grant now. Talked about the capital grant. Now let me talk about the second type of grant, and that is the revenue grant. How do you account revenue grant? That's not a big deal. So just put down another subheading, accounting for revenue grant. Accounting for revenue grant. Accounting for revenue grant. Accounting for revenue grant. Now listen, I told you this. Is a grant that you are receiving in relation to income. Listen, told you it could be that you are given a grant towards the running of your business. When you receive that grant, just consider it as an income straight. You received a grant this year to pay for employees training. Maybe the government is sponsoring training of your employees. You are given 2 million shillings to sponsor the running or the training of your employees as a business. That means you just consider the 2 million as an income, meaning you just debit bank, credit P&L account, or you credit the income account. Just say this. So you have said, another subheading, you have said accounting for revenue grant. Then you say this. With this method, the grant is treated as an income in the profit and loss. Grant is treated as an income in the profit and loss. Grant is treated as an income in the profit and loss. Good. That's okay. Just debit bank, credit, grant income. Maybe you can even put it there. Debit bank, whatever it is, credit grant income, stroke P&L, the same. Debit grant income, debit cash, credit grant income, of course, then you transfer it to the P&L account. No problem. Whatever you receive, 2 million, 3 million, just debit bank, credit grant income, which will go to the P&L account. That's not a big deal. Okay? Another subheading, let's talk about the third type of grant. What was it? Type of grant, the third one was non-monetary. How do you deal with it? You received a machine or land or a building, the government. How do you account for it? Okay? So have another subheading. Accounting for non-monetary grants. Accounting for non-monetary grant. Accounting for non-monetary grant. E.g. transfer of land. The same accounting for non-monetary grant, e.g. transfer of land, e.g. transfer of land. Then you say this should be measured or to be valued, put it that way. This should be valued at its fair value. This should be valued at its fair value. So you'll only determine what's the market value of this building, what's the market value of this land, and in your books you recognize it at its fair value. In the market price, what's the market price, what's the fair value, recognize it at its fair value. Okay? That's all we can say concerning 3 types of grant, how to account for them. Now we want to do an example, especially the first type of grant, and that is the capital grant. Let me put down an illustration, or let's put down an illustration. Let's put down an illustration now. So how do we account for government capital grant? So have an illustration. Example. Andika example. Example. Then you say this. Example. Then you say this. ABC Limited received a grant of shillings 20 million. Received a grant of shillings 20 million towards the acquisition. ABC Limited received a grant of shillings 20 million towards the acquisition of shillings 100 million machine. Towards acquisition of shillings 100 million machine. Stop. Another paragraph. The machine has a useful life. The machine has a useful life of 5 years. Machine has a useful life of 5 years with a residual value. With a residual value of shillings 10 million. With a residual value of shillings 10 million. With a residual value of shillings 10 million. A residual value of shillings 10 million. Required. Show the profit and loss. And balance sheet extracts. Show the profit and loss and balance sheet extracts. Show the profit and loss and balance sheet extracts. Show the profit and loss and balance sheet extracts for the first 3 years, The first 3 years, show the profit and loss and balance sheet extracts. First 3 years, using the 2 approaches. Using the 2 approaches for accounting. Using the 2 approaches for accounting capital grant. Using the 2 approaches for accounting capital grant. Using the 2 approaches for accounting for capital grant. Okay. Let's put down the 2 methods. One we have already said is which one? Method 1, we can use cost reduction. Let's put method 1. cost reduction or asset cost reduction method. Asset cost reduction method. Asset cost reduction method. Asset cost reduction method, that is even shorter. So that one I told you, listen, we are receiving a grant of how much? 20 million. You just debit bank to credit the asset. That's all. Once you account for that, debit cash and credit the asset by 20 million, obviously you will remain with how much? With 80 million. So maybe you can put there determination of the carrying amount. Determination of the carrying amount. Determination of the carrying amount of the machine. Determination of the carrying amount of the machine. Determination of the carrying amount of the machine. So is equals to 100 million minus 20 million. 100 million minus 20 million. Now back in how much? 80 million. That's the value we know. I have nothing to do with the 20 now after this. Let's just consider that. We use it now. So just come and say your P&L extracts. Profit and loss extracts. We are told to do for 3 years. So you have a column for the year. You have a column for the depreciation charge. Year 1, year 2, year 3. Don't forget, listen to this now. Don't forget that this machine has a residual value. You all know whenever you have an asset which has a residual value, you're using straight line. You normally take the cost minus the what? Minus their residual value, what you call scrap value. So you divide by the useful life. So we are saying, let me first do the first year. It will obviously be 80 million minus the residual value was how much? 10 million. You divide that by the useful life of 5 years. What becomes the depreciation charge for that year? Let me calculate it. What becomes the depreciation charge for that year? It will be 80 million minus 10 million. Whatever you get, you divide that by 5 years. So every year, we are depreciating our asset by 14 million. 14 million, 10 million, 14 million. That's all. Okay? You through with that? We go to the balance sheet now. That's all. You can come and see your balance sheet extracts now. Balance sheet extracts. 1, 2, 3. Then you have machinery. Then less accumulated depreciation. We remained with a net of 80, mark you, 80 minus the accumulated of 14 by end of year 1. What are you carrying down as the book value? This will be 80 minus 14, that is 66. Year 2, again 80, that becomes like the cost, minus accumulated of 28, Every year we are depreciating on a straight line. That is 28 now in year 2. What is 80 minus 28? That comes to 52. Come to year 3. Again 80 minus what is 14 times 3? That is 42. That means you are left with a balance of how much? 38. Good. This has no liability, don't forget. This is we are netted, there is no deferred whatever, no. Not bad. So there is no liability. Just show an asset and you depreciate it. But we are only showing the asset net of the grant. Yeah? Good. Let's do the second method now. Let's do the second method where we are accounting for the grant using the deferred income. If you are through Andika method 2, deferred grant income. Method 2, deferred grant income. First, before we do the balance sheet and P&L account, we need to open an account called that deferred income. We need to prepare that account called deferred income so that we prepare it, we see what we are carrying down. Let's do the account. Open an account called deferred grant income. Deferred grant income. Make it about 6 or 7 lines because we want to do for 3 years. Don't forget they have told us to do for 3 years. So first year you received how much? You received a grant of 20 million. I told you you have to debit bank and credit the grant. Come and see year 1, bank, 20 million. That's what we received. This time you don't net it against the cost. The cost remains 100 million. Is it 100? Yes, the cost was still 100. I think so. Let me confirm. Question? Yes. Cost will still remain 100. But now we are considering this 20 million as a deferred. We are saying you recognize it as an income in the P&L account over its useful life. So by end of year 1, how much am I transferring this account, the P&L account? Over the useful life of 10 years, it means I'm recognizing, no, the useful life was, I think, 5 years. Sorry, not 10. Yeah, I think 5 years. Yes. So we divide that by 5. So we are recognizing 4. Think you'll forget 20 divided by the useful life of 5 years. That's how we are getting 4 million. Grant is 20 million. The useful life is 5 years. Every year you transfer from the grant account or the deferred account to the P&L account 4 million. Then you carry down the balance by end of year 1, which looks like 16 million. Bring it down by the beginning of year 2. That is 16. Then you transfer again this second year to the P&L account, another 4 million. Come and see year to year 2, P&L account, another 4 million. How much are you carrying down as a liability? Balance carried down, looks like 12. Come to the third year, 3, balance brought down, 12 million. Then I transfer how much to the P&L account? Another 4. Come and see here, year 3, P&L account, another 4. You are carrying down a balance of how much? I think 8. Good. Now I've done the income, the deferred account. Finished. We want to prepare the P&L extract and the balance sheet now. We want to prepare P&L extract and the balance sheet. Okay. Finish. If we are through, I've told you this time in the P&L account, 2 things will go to the P&L account. Don't forget. You have an asset which you have to be depreciated. And every year you are recognizing an income in form of grant income. Okay? This time 2 things will go to the profit and loss. 2 things will go to the P&L account. That's what we want to do now. Come and see your P&L account. P&L extracts. We have been told to do for 2 years. No, 3 years. So you'll have a column for the year. 1 year, 2 year, 3. Then you may have a column for depreciation charge and grant income. Grant income. Grant income. So, of course, in the P&L account, what am I charging as depreciation? Listen, the cost is 100. Let me put it down here. 100 minus. Don't forget this one has a residual value of 10 million. Are you there? Divide that by the useful life of 5 years. Every year I'm depreciating my asset by how much? What was the residual value? I think it was 10 million. Let me confirm. Yeah, 10 million. That was the residual value. So if it is that, then it means I'm taking 90. 100 minus 10 is 90. Divide by 5. That comes to 18. Every year you'll be charging 18 in the P&L account as depreciation. Are you there? Every year you charge 18. At the same time, you will recognize an income every year. We received a grant of 20 million. To be recognized as an income over the useful life of 5 years. Every year I'm going to recognize an income of 4 million. That one we have seen, 4 million. Okay. After that, now we go to balance sheet. If you're through, let's do the balance sheet extracts now. We have done P&L extracts. In the balance sheet now you have assets and you have liabilities. There is an income you have received in advance. I've told you any income received in advance is a liability. So let's determine. Come and see your balance sheet extracts. Have a column for year 1, year 2, year 3. You're through. Then among the non-current assets, there you will have machinery at cost. Then you have accumulated depreciation. Then still in the balance sheet extract, among the non-current liabilities, you will have deferred grant income. Then I've told you Among the current liabilities again, you will have deferred grant income. Okay, so let's feed in the table now. Figures. Let's feed in the figures now. So our cost of the machinery was 100. We minus the accumulated depreciation, which we have just calculated, 18 million. Second year, 100 million. We minus the accumulated of 36. Third year, it will be 100. We minus the accumulated depreciation of how much? What is 18 times 3? That is 54. What leaves me with the book value? First year, 100 minus 18. That is 82. Second year, 64. Third year, 46. Okay? That's all for the third 3 years. Let's do the liability. We have to go back to the table, or to the account, sorry. We have to go to the account, see what are we carrying down by end of year 1 as deferred. Then we ask ourselves, out of that balance carried down, how much is long term? How much is current? That's what we want to do now. We go to the account. What were we carrying down? Look at the account here. We had a deferred income of 16 by end of year 1. Told you that in the next 1 year, we shall have recognized 4 out of 16. Then I told you it means out of 16, 12 will take me more than a year to recognize. By end of year 1, we have a deferred of 16 years. But out of 16, 4 will take me less than a year to recognize as an income, and 12 will take me more than a year to recognize as an income. Let's put 12 as deferred long term in the balance sheet, 12, while current is 4. While current is 4. Hope you are following. Yes. Now we go to the second year. Now. In year 2, we are carrying down how much? We are carrying down 12. Hope you can see it there. That's what we are carrying down. Carrying down a deferred income of 12. In the next 1 year, I should recognize how much? 4. That is what we shall recognize in the next 1 year out of 12. Leaves me the balance of 8. Take me more than a year to recognize. In the second year, out of 12 I'm carrying down, 8 is long term, while 4 is current. While 4 is current. Are you there? Good. Finally, year 3, go back, I check what am I carrying down. I'm carrying down 8 million by end of year 3. We have already agreed out of that 8, 4 million will take me less than a year. That will be current. And it leaves me, therefore, with another 4 million be recognized as long term. You there? Good. That's all for the 3 years balance sheet. That's what the question was asking us to do. Finish. Normally, it's not a long topic and it's not a hard one. It's a question you can get good marks if it comes. Question you can get good marks if it comes. And now summarize what we have said so far. Let me summarize what we have said, because in principle, we are through with the topic. Principle, through that topic. So what we have done, listen, we have defined what's a government grant. We have said it is an assistance received from the government in form of transfer of resources. Those resources could be in cash or in kind. Are you there? Good. Once I said that, I said, what type of grants can you receive, government? Said there are how many types? 3. 1 is you can receive a capital grant. Said, what's a capital grant? It's a grant that you are receiving towards the purchase or construction of a long-term assets. Any grant you are receiving towards the purchase or construction of a long-term asset, that's what we call a capital grant. See, these are grants relating to assets. Okay. But 2, revenue grant. What is it? It's grant relating to income. Grant relating to income of your business. That means to meet the normal operating. 3, non-monetary grant, e.g., say transfer of a land. Government gives you land or a machinery. That means they give you that asset itself, not in form of cash. Yeah? Good. Then once we discussed what are the types of grant, now we have discussed how to account for them. We have said, if it's a revenue grant, revenue grant, which is a grant relating to income, what have we said? Just consider it as an income in the P&L account. Debit bank, you credit grant income or you credit P&L account. Yeah? Debit bank, then you can credit grant income. Then by the end of the year, you transfer the balance of the grant income to the P&L account. By debiting grant income, crediting P&L account is the same. Or you debit bank, credit P&L account direct the grant income. Yeah? That's what we're saying. When you receive a revenue grant. How do you account for capital grant? Said there are 2 methods of accounting for capital grant. One is called asset cost reduction method. What is it about? Where you deduct the grant from the cost of the asset so that you determine the reduced carrying amount of the asset. See, that asset now will be depreciated on the reduced amount. On the reduced amount. Yeah? That's all we said about first method, where the grant is deducted against the cost of the asset. 2 methods, what we are calling deferred grant income, or you can call it deferred income grant, whatever it is, where the income or grant is considered as a deferred income to be recognized as an income over the useful life of the asset. Over the useful life of the asset. Good. Say, most important thing is in the balance sheet, show the original cost of the asset. Don't net it this time. The other thing we have said, in the balance sheet, you have received a grant to be considered as an income over a long period of time. Part of that income will be considered as long-term liability. Part of it will be considered as a current liability because you have received an income and it's like you are receiving it in advance. And you know an income received in advance is considered as a liability. But now that you are carrying down, like in year 1, you are carrying down 16 million as deferred income. Then I asked myself, how much of that 16 that I'm carrying down will take me more than a year to recognize as an income? How much of it will take me more than a year? How much of it will take me less than a year? I told you, whatever you recognize out of 16 in the next 1 year, that is considered as current, which in our illustration is 4. Leaves me the balance of 12 out of 16 in year 1 to be an income that take me more than a year to recognize. Therefore, I take it to my balance sheet as long term. Second year, I carry down 12. I ask myself, how much of that will take me less than a year to recognize? In other words, how much of that will be current liability? The amount to be recognized as an income in the third year, which is how much in our illustration? 4 million. And out of 12, leaves me with a balance of 8, which will take me more than a year to recognize as an income. That way. Good. That's all we can say about the capital grant and the two methods of accounting for capital grant. Then finally, we have talked about the non-monetary grant. How do you account for them? When you are given land, given machinery, not cash to purchase machinery. You are given a machinery. Just value it at its fair value. In other words, you recognize it in your books at its fair value. Same as market value, which is the same as market value. Good. So that brings me to the end of that topic. It's not a long one. Sometimes you have been asked theory questions in your past papers. Maybe for today we can stop there, pick it up from there next time, where we shall now even start with a new topic. But remember, I've told you, please, if you have not subscribed to my YouTube channel, please subscribe. That's I've said. Just click that subscription button. If you have not subscribed, maybe you are new to the channel, or maybe you are new to this class for today, subscribe. And I've told you, tell your friends about our online classes. One for advanced financial reporting, advanced level, either early morning or evening classes. Tell them about the financial reporting of the intermediate, the one we are doing, or financial accounting of foundation level of CPA or ATD level 1 and level 2. There are some who are doing even CIFA. That talk about that. Then I've said, if they are not able to join the live classes, we have agreed they can buy what we call pre-recorded videos. Where they can watch the videos at their own free time, at their own pace. Said the charge is 4,200, where we normally accept payments also on installments. That's what we have said. Then we have also said, anyone interested can call me on 0722 658875. 0722 658875. Good. Maybe for now we can stop there. Pick it up from there next time, where now we shall start something else. That was a short topic. It's part of your syllabus, but we have to still do it. See you next time. Bye for now. See you. Okay. Bye for now.